Hey everyone, welcome to Ledger Labs podcast. I'm Allison Reinheimer. I'm the operations manager here at Ledger Labs. Now, if you've been listening to the show, you know Gary Jane usually hosts. He's been doing an amazing job for the last few episodes. But today, we're switching things up. I'm in the host seat and Gary's joining me as our guest. And honestly, I needed Gary here for this conversation because we are officially in December 2025, which means we have less than 4 weeks before one of the biggest tax law changes in modern history hits. And most business owners have absolutely no idea what's coming.
Yeah, this is not hyperbole. January 1st, 2026, the Tax Cuts and Jobs Act provisions expire. And if you're a business owner, especially if you're an LLC or S Corp, your tax bill could jump by $20,000, $30,000, even $50,000 or more.
And here's what's scary, Gary. I've been talking to our clients and maybe 1 in 10 actually knows this is happening. The rest are just going about their business, assuming nothing's changing.
Yeah, and that's why we're doing this episode right now. Because there are still things you can do before December 31st, but the window is closing fast.
So if you're listening right now and you own a business or you advise business owners, this might be the most important episode we've ever done. Because what we're about to talk about could literally save you tens of thousands of dollars. Let's get into it. Okay, Gary, let's start with the basics. What exactly is expiring on December 31st? Like, what are we actually talking about here?
All right, so back in 2017, Congress passed the Tax Cuts and Jobs Act, TCJA, and it changed a lot of things for business owners and individuals. But here's the catch. Most of those changes were temporary. They were designed to sunset after 8 years, which is right now.
So what happens when they sunset?
We basically go back to the 2017 tax code, which means higher tax rates, fewer deductions, and for business owners specifically, and this is the big one, the qualified business income deduction disappears.
Okay, so let's talk about that, the QBI deduction. Because I think that's what's going to hit our clients the hardest. Explain what it is and what happens when it's gone.
So the QBI deduction, also called the Section 199A deduction, it allows owners of pass-through entities like LLCs, S Corps, partnerships, sole proprietorships to deduct up to 20% of their qualified business income from their taxable income. So if you're an S Corp owner and your business throws off $200,000 in net income to you, you could deduct $40,000. $40,000 just off the table for tax purposes.
That's huge.
It's massive. And on January 1st, gone. That entire deduction just evaporates. So that same business owner who was getting a $40K deduction, they're now paying tax on the full $200,000.
So at the new 2026 tax rates, which are also going up, we're talking about an additional tax bill of what? $10,000 to $15,000?
At minimum. And for business owners making $500K, $750K, $1 million, we're talking $30,000, $40,000, $50,000 or more in additional taxes.
And if you're listening right now thinking, wait, is he talking about me? If you own an LLC or S Corp and you're profitable, yes, this applies to you. Unless Congress extends it, which as of today, they haven't.
Right. And look, Congress might extend some of these provisions. There's talk about it, but you cannot bet your financial future on might. You have to plan assuming it expires. And if they extend it later, great, bonus. But don't get caught unprepared.
Okay, so that's the QBI deduction. What else is changing that business owners need to know about?
All right, so number 2, tax brackets are reverting. The 24% bracket goes to 28%. The 22% bracket goes to 25%. The top rate goes from 37% to 39.6%. So even without losing QBI, you're paying higher rates on the same income.
So it's like a double hit.
Exactly. You lose the deduction and the rate goes up. Number 3, bonus depreciation continues to phase out. It's already down to 60% in 2024. It'll be 40% in 2025 and 20% in 2026. So if you are planning to buy equipment, vehicles, machinery, do it before December 31st to maximize your depreciation.
And what about the standard deduction? I've heard that's changing too.
Yeah, that one affects individuals more than businesses, but it's still important. The standard deduction gets cut almost in half. Right now, it's about $30,000 for a married couple. In 2026, it drops to around $16,700. So more people will need to itemize, which means more complexity and potentially higher taxes if they don't have enough deductions.
Okay, but there's one piece of good news in all this, right? The SALT cap?
Yes, finally some good news. The state and local tax deduction cap, which limited you to deducting only $10,000 in state and local taxes, that cap goes away. So if you're in a high tax state like California, New York, New Jersey, and you've been hitting that 10K limit, you'll actually be able to deduct your full state taxes again.
So that helps soften the blow a little bit. But overall, for most business owners, this is a net negative, right?
Absolutely. The SALT cap relief doesn't come close to making up for losing QBI and higher rates. For most business owners, 2026 means a significantly higher tax bill.
So if you're listening and you're starting to panic a little, that's actually the appropriate response. But here's the good news. There are things you can still do before December 31st. And that's what we're going to talk about next. All right, Gary, let's get tactical. We've got less than 4 weeks. What should business owners be doing right now?
Okay, so first thing, and this is critical, meet with your CPA or tax advisor immediately, like this week. If you haven't had a tax planning conversation yet for 2025, you're already behind. And December is when CPAs are slammed, so don't wait until the 20th and expect to get on their calendar.
Yeah, as a CPA, I can confirm December is insane. So book that meeting now. What should people be discussing in that meeting?
So the first question is, should you accelerate income or defer it? Now, conventional wisdom says always defer income to next year. But 2026 is different. If you're going to lose your QBI deduction and face higher rates, it might actually make sense to pull income into 2025.
So deliberately pay more tax this year because next year will be even worse?
Exactly. Let me give you an example. Say you're an S-Corp owner and you've got a big client who owes you $100,000. Normally, you'd let them pay in January to defer the tax. But if you can get them to pay you in December, even if you offer a small discount to incentivize it, you get the QBI deduction this year at the 24% or 22% rate versus next year, no deduction, higher rate. The math works out way better.
That's counterintuitive, but it makes total sense. What else should people be looking at?
Second, maximize your deductions in 2025. Buy that equipment you are planning to buy. Prepay expenses where it makes sense: insurance, rent, professional fees. Stock up on inventory if you've got the cash flow. Anything you can legitimately deduct in 2025, do it now while you've still got the higher depreciation rates and the QBI deduction to stack on top of it.
And for anyone listening who's thinking, I'll just wait and see what Congress does, don't. Because by the time they act, it'll be too late to take advantage of 2025 planning.
Absolutely. Plan for the worst, hope for the best. Third thing, consider your business structure. And this is the big one that not enough people are talking about.
You mean like switching from an S Corp to a C Corp?
Exactly. So right now, if you're an LLC or S Corp, you're paying pass-through taxes. Your income flows to your personal return. With QBI, that was great. Without QBI, you're potentially paying 39.6% federal, plus state tax, plus self-employment tax in some cases. Meanwhile, C Corps pay a flat 21% corporate tax rate, which was permanent under TCJA and isn't changing.
Okay, but there's the double taxation issue, right? You pay corporate tax, then when you take distributions, you pay tax again as dividends.
Yes, but here's the thing. For a lot of businesses, especially if you're not distributing all your profit, if you're reinvesting in growth, that 21% flat rate can be better than the 35%, 39.6% you'd pay as a pass-through. It's not right for everyone, but it's absolutely worth modeling.
So if you're a high-earning business owner and you've never considered a C Corp structure, now might be the time to have that conversation with your advisor. Because the math is changing dramatically in 2026.
Yeah, and just to be clear, you can't just flip a switch on December 31st. There are procedures, there are elections you have to file. So if this is something you want to explore, start the conversation now so you have time to execute if it makes sense.
Okay, what else should business owners be thinking about?
Fourth, retirement contributions. Max out your 401k, your SEP IRA, your defined benefit plan if you have one. These deductions become even more valuable when rates are going up. And if you're self-employed and you haven't set up a retirement plan yet, you have until the end of the year to establish one for 2025.
And those contribution limits are pretty high for business owners, right?
Yeah, depending on your setup, you could be putting away 60K, 70K, even over 200K in some cases with certain defined benefit plans. That's a huge tax deduction.
Okay, so to recap for everyone listening, meet with your tax advisor this week. Consider accelerating income into 2025. Max out deductions and equipment purchases. Evaluate your entity structure. And max out retirement contributions. Is there anything else?
Yeah, one more big one. Estate planning. The estate tax exemption is also getting cut in half, from almost $14 million per person to about $7.25 million. So if you have significant wealth, you need to be talking to an estate attorney about using up that exemption before it goes away.
And that's not just for ultra wealthy people, right? Like if you own a business and some real estate, you could be closer to that number than you think.
Exactly. Especially in California or New York, where real estate values are high, you might have a $2 million house, a business worth $3 million, some retirement accounts, life insurance. You could be at $7 million without feeling rich.
So if you're anywhere close to that number, or even if you think you'll be there in the next 10 years, talk to an estate attorney about gifting strategies before December 31st. Because once that exemption drops, it's gone. Okay, Gary, I want to ask you some of the tough questions I know people are thinking. First one, what if Congress extends these provisions? Won't all this planning be for nothing?
Great question. So yes, Congress could extend some or all of these provisions. And if they do, then yeah, some of this planning might have been unnecessary. But here's my take. Better to plan and not need it than to need it and not have planned. Plus, even if they extend, it might not be retroactive. Or they might extend some provisions but not others. So you can't count on it. And the cost of preparing for the worst is way lower than the cost of getting caught unprepared.
Yeah, this is not a wait and see situation. Okay, second question. What about small businesses? Like if you're only making $75,000 or $100,000 in profit, is this still a big deal?
Absolutely. Look, losing 20% of your income as a deduction hurts no matter what your income level is. If you're making $75K and you lose a $15K deduction, that could be an extra $3,000 to $5,000 in taxes. For a small business, that's real money.
Yeah, that could be the difference between hiring someone or not, between investing in new equipment or not.
Exactly. So don't think I'm too small for this to matter. It matters for everyone.
Okay, final tough question. How worried should people actually be about this? Like, is this a drop everything and panic situation, or is it more be aware and plan accordingly?
I would say it's urgent but manageable. You should absolutely be taking action now, like this week. Don't wait until December 20th. But if you work with your advisors, model the scenarios, make smart decisions, you'll be okay. The people who are going to get hurt are the ones who ignore it, who assume it'll work itself out, who don't meet with their CPA, who don't adjust their strategy. Those are the folks who are going to file their 2026 tax return and get shocked by a massive tax bill they weren't expecting.
And by then it's too late to do anything about it.
Exactly. You can't retroactively change 2026 once it's over. You have to plan now in 2025 while you still can.
So here's what I want everyone listening to do. As soon as this episode ends, I want you to do 3 things. 1, send an email or make a call to your CPA or tax advisor. Get a meeting on the calendar. This week if possible, but no later than mid-December. Tell them you want to do year-end tax planning with specific focus on the TCJA expiration. 2, pull together your financial information. How much profit are you on track to make this year? What major expenses or purchases are you considering? What's your cash position? The more prepared you are for that meeting, the more valuable it'll be. And 3, start thinking about those strategic questions Gary raised. Should you accelerate income? Should you defer expenses or accelerate them? Does it make sense to evaluate a C Corp conversion? You don't have to have the answers, but start thinking through the questions.
Yeah, and I'll add one more thing. Don't be afraid to get a second opinion if you need it. If your current advisor isn't talking to you about this stuff, that's a red flag. At Ledger Labs, we're literally having these conversations with every single client right now. This should be top of mind for every tax professional in the country.
That's a really good point. If your advisor hasn't brought this up yet, that's worth noting. Okay, Gary, before we wrap, I want to give you the last word. What's the one thing you want people to take away from this conversation?
I think it's this. 2026 represents one of the biggest tax shifts we've seen in decades. And shifts create both risks and opportunities. The risk is getting caught unprepared and paying way more than you should. But the opportunity, if you act now, is to position yourself strategically, make smart decisions in 2025, and potentially save tens of thousands of dollars. So don't panic, but do act. Don't assume Congress will save you, but do work with professionals who can help you navigate this. And most importantly, don't ignore it. This is too big to pretend it's not happening.
That's perfect. Gary, thank you for breaking this down. I know this is a heavy topic, but I think we gave people a clear path forward.
Thanks for having me, Allison. And I hope this helps people take action.
All right, everyone, that's it for today. If this episode helped you, please share it with another business owner. Seriously, this information is too important to keep to yourself. Send it to your entrepreneur friends, post it in your business groups, whatever. We want as many people as possible to be prepared for what's coming. And if you need help with year-end planning or you want to work with us at Ledger Labs, head over to theledgerlabs.com. We're here to help you navigate this. Remember, you've got less than 4 weeks to act. Don't waste them. See you next time.